Meta stock is up 25% this year, taking the company's market value to just under $1.9 trillion. The company has reported $179 billion of revenue over the last 12 months, $94 billion of EBITDA and $72 billion of net income. That means Meta stock is now valued at 10 times revenue, 26 times earnings and 20 times EBITDA. That may not seem too much for a company that's still growing 20%, but there are some important considerations to bear in mind. Over the last few years, Meta has been investing huge amounts of its cash building out AI data centers. The company's planned Hyperion data center is expected to cost $50 billion, reaching the size of Manhattan. CEO Mark Zuckerberg said the company plans to spend $70 billion this year and $600 billion by 2028. The company is clearly playing to win, and it's taking on increasing amounts of debt to do so. Meta's total debt balance has almost quadrupled since 2021. So while Meta doesn't look that expensive according to its PE ratio, when you factor in capital investment, it's a different story. For example, once you account for this year's expected capex of $70 billion, the company is more realistically trading at 47 times this year's free cash flow. That's a much more aggressive multiple. And it's a similar story for some of the other Mag-7. Microsoft trades at 39 times earnings but 55 times free cash flow. Amazon trades at 35 times earnings but 180 times free cash flow. And Google trades at 26 times earnings but 44 times free cash flow. There's another issue to consider as well. Server equipment like GPUs don't last forever. They need to be replaced every few years when they wear out or become superseded by the latest models. So the huge capital investment these companies are taking on isn't just a one-off cost, and the depreciation schedules being used, sometimes 5 to 6 years, may be too optimistic. Of course, Meta and the Magnificent Seven are still fantastic businesses that generate huge amounts of money, and Meta's near monopoly in social media advertising seems to be unassailable at this point. But AI is going to produce winners and losers, and it's impossible to predict if the large sums that these companies are investing will generate positive returns. The question is whether a few extra points of growth is worth the hundreds of billions of dollars that is being spent. We probably won't know the answer for some time, but what we do know is that Meta and the Magnificent Seven stocks are more expensive than they look. But these are my personal opinions, not financial advice, and I don't hold any position in any of these stocks. For more investing ideas, make sure to join my newsletter at 3minutebreakdowns.com. Thank you for watching.